We've been told a recession is coming. The real estate market is going to crash again just like in 2008. Well, wait a minute, not so fast. Look at the market, it's near all-time highs. But is it really? If you were to pull out the top 7 stocks when you see the numbers on this, it's staggering. And on top of that, there is an indicator of when a recession actually hits. And it isn't while we're raising interest rates. The Fed. It happens after we stop raising rates and wait till you see how long it takes for the market to crash. I got a bunch of other data to share with you, but I've learned one thing for sure. Only the paranoid survive, and those who are way too confident are typically wrong. And those who are way too cocky are also typically wrong. Okay, so if you get value out of this video, give it a thumbs up and subscribe to the channel. Let's get right into it. So here's US interest rate hikes in the history of America. When we raise rates, we have never raised 88 percentage points, as quickly as we did in the States. So if you look at this here, the yellow to the left shows how quickly we kept increasing grades, and you'll see the lowest was from 2015 to 2018. When we raised 2 points, then you'll see 1999 to 2000. We raised 1.51, and then you'll see 2004 to 2006 over 2 years. We raised roughly 4 points, 94 to 95, 2.67, 88 to 89, 0.3, but nothing comes closer. The 22 to 23, 88. But what does this really mean? So if we look at the balance sheet of this is pretty much the quantitative easing balance sheet. If you look at the top, that shows how much bonds the Fed is buying. But if you look at the bottom, the M2 money supply shows how much money is circulating in the economy. So you notice if you go to 2020, look how historically it's gradually climbing, but it's nothing that's sudden. Then all of a sudden, boom, we feed the economy, the market, with trillions of dollars we're not accustomed to. And we don't have another case study for somebody to say, well, here's what's going to happen. Well, it's totally okay. Well, don't worry about it. Based on what? The reality of it is nobody knows 100% what's going on because we've never been here before. So let's continue. So then 2024 projections. What's next for the US economy? They did a survey to find out who thinks a recession is coming. Look to the left. The Fed staff says 0% there's not going to be a recession. Remember, they're in the business. So they're supposed to be saying that because that is Wall Street, right? Yield curve says 61% chance of recessions coming next 12 months. Economists are at 48%. Consumers are at 69%. That's Main Street. UNI Goldman Sachs is saying only 15% Bank of America, 35 to 40%. But look at CEOs, 84%. Okay? C-suites are saying 84%. Now what would CEOs know that the rest of them don't know? Maybe they know their debt payment. Maybe they know when their debt payment interest rates that they got was lower. That if they have to renew the debt that they got, it's going to go up here. How are we going to make those payments? Maybe we ought to look at what some of these CEOs are talking about. And if you go to the bottom, you'll notice the percentage of S&P 500 companies citing keywords on earning calls. Look at what's happened from Q2 2022 to Q2 2023. What words they're using fewer times. Inflation has decreased. Material costs decreased. Economical slowdown decreased. Job cuts went up, but it's also decreased. So, could this be a sign that everything's going to be okay? If yes, why are CEOs? It's at 84% saying a recession is coming. Are they Houdini? Are they Nostradamus? Are they somebody that can predict the future? What do they know that the rest of the people don't know? Now, when it comes down to the S&P 500, these are the 500 biggest companies in America. Something very interesting is happening. There are 7 companies that make up 28% of the S&P 500. Let me break this down for you. 500 biggest companies, 7 companies, make up 28%. In the history of S&P 500, never has there been a time where 7 companies make up 28%. We've never had 7 companies, too big to fail. We've never had 7 companies. Now what are these companies? You got Meta, Facebook, Nvidia, Apple, Microsoft, Alphabet, Amazon, and Tesla? So why is this important? Here's why. If you look at the S&P 500 year-to-date returns, you will notice a number roughly around 12. 4% could be higher, could be lower, but it's not 12. You know what Magnificent Seven's return is for the year so far? Roughly 92. So what happens if you take the 7 stocks? Out. And there's only 493 stocks left. How's the S&P 500 doing? It's down. So the 7 are pulling the rest of the market, and it looks like everything else is okay, but is it really? So we decided to break it down to see how small cap companies were doing, mid cap companies were doing, versus large cap companies. And you will notice a trend here. Watch this. Okay. So if you look at this chart, you'll notice 3 different funds here. One is the SPY, which is the S&P 500. The other one is the Russell 2000. Then you have the microcap ETF. So if you look at these, the S&P 500 is companies valued roughly at 12. 7 billion or higher top 500 biggest companies in America. Russell 2000 is company sizes, 300 million to 2 billion market cap. And then the microcap is from 50 million to 300 million. So if you look at this, what do you notice? You'll notice SPY is up 66%. The rich get richer, the big get bigger, the stronger get stronger. Great. Russell 2000 is only up 7%. But look at the microcap. Microcap companies are down 85%. So why is that? Is it the bigger guys can afford to go through a season like this? They can weather the storm, and it can kind of handle it because the amount of cash they have in capital they have in the smaller guys cannot possibly. But we cannot fool ourselves thinking the market is up just because these 7 magnificent companies are carrying the weight.